Hello, this is Scott Jackson of Jackson Private Wealth Management, a registered investment advisory here in the state of Florida. Thankfully, 2020 is just about over. But before we stick our toe into 2021, let's talk for a moment about the markets and how we wound up where we are. Now, our story revolves around two old friends, Fed and Fiscal. Old friends who sat on the Wall Street park bench like bookends, all the way back to the last financial crisis. Fed decided back then that he could get the economy going again if he just turned it on its head, meaning that instead of the economy drive the stock market, what if I could have the stock market drive the economy? How can I do that? Well, I know what I'll do. I'll buy bonds to the tune of, say, $85 billion a month, and by so doing, we'll push the yield down, and we'll take bond buyers right out of the bond market and move them over into the stock market. When you take a historic average yield of, say, around 5% on the 10-year Treasury, and you drive it down to parity with the S&P yield, say somewhere around 2.5%, what else are investors going to do? And then again, here with the coronavirus, what if we push the yield down on the 10-year down to below 1%? Now we'll really give investors an incentive to consider the stock market at a yield of 2 or better on the S&P 500. And so that's what we've seen. Investors have largely turned their back on the full faith and taxing power of the U.S. government because it means getting paid so little at the moment versus what the potential is in the stock market. Meanwhile, Fiscal, he's been sitting on the bench waiting for his turn. Back in 2012, the Build America bond program wound down, and so subsequently the U.S. government has been less focused on infrastructure and more focused on other things. But we see that taking a turn, and things come in cycles. So likely the fiscal stimulus will pick up because the monetary stimulus has already started to wane in its ability to assist. So where do we go in 2021? How are we positioned going forward? Well, we believe that value is the place to be. It's been an unusual time period where growth has outperformed over the last 5 years or so, and we don't think that will continue. We think all this excitement for the tech sector has pushed multiples, price to earnings ratios there, back up to about where they were in 2000, right before the big bubble burst. And so we do have our concerns. Even if the bubble doesn't burst, we do worry about prices coming back down to earth. So what do we think will happen? Well, we think there will be a big rotation. Just as investors jumped in on the stock market in March of this year under the premise of FOMO, fear of missing out, recognizing that 2009 was a lesson, we think investors will take a lesson from 2000 and start to rotate out of tech this year and into the value parts of the market because the vaccines are going to free people again to move about and do what they want to do. And we think a lot of spending in those areas will pick back up. And so our Jackson-focused stock model is focused on U.S. value, and our Jackson Global stock model is focused on global value at the moment. Now, what about our bonds? Well, we have reduced our overweight to the U.S. bond market via our Jackson focused bond model and evened it out with the Jackson Global model. We believe that the U.S. is now paying yields that are far less compelling, and so therefore investors will likely look for opportunities in other places too. With all that being said, are we still hedged a bit? We are. We still have a significant position in our Jackson Global Tactical model to long treasuries, which tend to do very well when the stock market sells off. So in the event that we do get a big sell-off in 2021, that will help to offset the loss to a degree. Many things to talk about. It is a complicated world, and we can help.